Now let's talk about some of these Greeks. The first one we'll talk about is the delta. Now the delta is the sensitivity of an options price relative to the price movement in the underlying security. In English, I'll explain what that means. Let's go back to our $5 stock that we looked at before. It's at $5 and we have a $5 call option which is worth 30 cents. We would call that option at the money. And we say it's at the money because we know there's a 50-50 chance that the shares could either be the shares could be above $5 or below $5. Therefore, we can easily say the delta is 0.5. Now, what that'll mean is if the underlying share, our $5 stock, if that rises from $5 to $5.10, our option will get half that price movement reflected in its price because of the delta. So again, if our shares were at $5 and you have bought a $5 call for 30 cents, and then those shares go from $5 to $5.10, that's a 10-cent increase. The option will have increased by 5 cents. It'll be worth now 35 cents. And you can see here that an in-the-money option has a delta greater than 0.5 up to 1. An out-of-the-money option has a delta less than 0.5 down to 0. So the scale for a delta is between 0 and 1. The delta also is a measure of an option share exposure, and the delta is also the leverage gauge. Another example will just make it clear. So here we have our ABC stock. It trades for $10. The ABC $10 call option trades for 50 cents, and we have 3 months until expiry, and our delta is 0.05. So it's 0.5. Now the ABC $10 call option is the same as owning 500 ABC shares at that point in time. Now remember, one options contract equals 1,000 shares. So if you exercise the options contract, you will then have the right to buy 1,000 shares. But at the point that you've just bought the option, it is equivalent, in this example, of owning 500 shares. Now let's say our ABC stock rises to $10.20. That means the shares have been increased in value by 20 cents. The $10 call options would now be worth 60 cents. That means the 20 cents that the shares increased by, our option would get 10 cents of that, or half of the movement. And that makes sense because if you only bought yourself 500 ABC shares and the stock went from $10 to $10.20, you've made that same proportion. Now, as the share price goes up, the value of that delta will also increase until it hits 1. And the best way to think of that would be if you have a $5 stock and you just so happen to own a $1 call option. You'd be very, very deep in the money, and that delta of that option would be very close to 1. And if the underlying share went from $5 to $5.20, the value of your option would also go up by 20 cents. It then starts to act just like a share. And that's where the leverage really kicks in. Theta. Theta is the sensitivity of the option value with respect to the time remaining, and the theta is really the measure of the rate of premium decay. We'll look at this in a moment when we look at an options model, but there's actually a variable that you can have calculated that will tell you that the option is expected to decay at this rate, and it's not a standardized set rate. As we get closer and closer and closer to that option's expiry, the theta value actually increases and increases because we are running out of time. And the last one is called the gamma, and this is the change in the delta of an option for the unit change in the price of the underlying share. In other words, the gamma is the measure of the rate of change for the delta. What I mean is if you have a $5 call option, the stock is at $5, we know the delta is 0.5. There will be a gamma that will tell us what the likelihood of the rate of change is if the shares go up, and it's just another measure. If anything, it's just for your own knowledge that that's what it is. Now, what's important for options is volatility. Volatility refers to the frequency and size of fluctuations of a share price over a given period of time. The greater and the more frequent the price movements, the higher the option premium will be, as there is a greater chance the underlying share price will be in the money at expiry. Now let's just summarise the option fundamentals. Now, an options price is a function of the following. Now, it's very easy for you to work out the intrinsic value of an option. You simply take the current share price, and if it's a call option, you simply subtract the call option strike price away, and if it's a positive value, that's your real value there. Now, working out the time value for an option, that's a little bit harder to do, at least in our own minds, because we've got all these other variables. Variables such as interest rates, dividends, volatility, and the time to expiry. Now, the volatility is the only subjective variable that's in the marketplace. We can calculate the actual historic volatility of a certain stock, but what they use in a market is an implied volatility statistic. And when we look at the model, I'll show you how all these things come together. But an options price is a function of all these variables. We need a stock price, we need a strike price, interest rates, dividends, volatility, and time to expiry. Okay, I'll now just get the options pricing model to work, and we'll just go into that right now and have a look. Okay, now this is actually an options pricing model. Now it might just be a little bit hard to see with what we've got, so I'll just go and zoom this in just so we can get better resolution. So we'll go to 150%. Now over here we have those various aspects that we need to put into the model. Like we need to know the stock, we need a share price, we need a strike price, the days till expiry. We put in here what the risk-free asset is. The risk-free asset means that's what you could expect to earn by buying, say, a 10-year bond. There's the volatility for the buyer and the seller. You'll notice we've got 19% and 20% respectively. This is an implied figure. A margin interval, which I'll come back to later. If there are any dividends during the period, we put them in here. And we're just talking about a stock here, ABC. Now with this model, I'll just scroll across here just so we can see it. We have a $10 strike price and we have the stock at $10. So therefore we can see the value of the calls and puts. We can see the calls are worth 45 to 47 cents. We can see the puts are worth 31 to 33. Now we'll just focus on the calls at the moment, and we'll just go down here and we can see that the delta of the particular $10 call is 0.58. Now let's just play around with the model. Let's see some effects. Now let's say the underlying share price actually increases in value. So you've been fortunate enough to buy yourself the $10 call. Let's say you actually went and bought yourself 2 of them and you paid 46 cents. Now the shares actually increase from $10 all the way up to $11. So let's see what effect that would have to our options price. Well, we go over to here and we can see the calls are now worth between $1.20 and $1.21. So we had a $1 move in the share price, and we can see that's had a bigger effect in our options price as well. Now let's go down here and have a look at our delta. Remember, the delta in the first place was 0.58. Now it's 0.88. And that makes sense because as the underlying share price continues to go up, let's say we now move this thing up to, say, $12. Watch what happens here to the value of the call. Notice how it increased in value. Now let's go back to being at $10 and let's show you the opposite effect. Now let's say our underlying shares actually drop $1, so they're now worth only $9. Now if we know the delta is about 0.58, we should therefore realistically expect that if the shares drop by $1, we should get about 60% of that should be reflected in the options price in terms of that fall. So let's see what happens here. The shares are now worth $9. And what's the value of our option? Well, it's worth about 8 cents. And if you look back at where your delta was, that would be about right. We now look down here, and we can see that the delta on our particular call option is now 0.18. When we had the stock at $10, it was 0.58. That's because our option initially was at the money, the stock decreased in value, so now that option is now out of the money. And when you have an out of the money option, you know the delta is definitely going to be less than 0.5. Now let's go back to $10 and let's play around with some of our time figures. So let's just have a look here. Now we've got 90 days until options expiry. Now, let me do that example before. Let's say 30 days pass and the shares stay at $10. They don't go up, they don't go down, so we now have 60 days. You will see here what happens to the value of the call. It's now worth about 36 cents. Let's say another 30 days pass. The shares don't go up, they do not go down, they stay. What's our call option now worth? Now it's worth about 24 cents. So you can see there, if you bought your calls at 46 and you've held them for those 60 days, they're only now worth 24. So on paper, you're down a fair bit. But this is where it really becomes quite important in terms of the time decay. Let's say we've got 1 day to go until options expiry. We just put 1 in there. There's the value of our call option. It's worth 4 cents. So 89 days ago, it would have been worth 46 cents. Today, it's only worth 4. And if I won't put 0 there because I'll get a 0 value, but let's say we're in the dying stages of the market, we'll see there it'll have just a slight value of about a cent. And of course, at the end of the day, it'll probably expire worthless. So that's why time decay is very, very important. It has a massive effect on options. Now, I'll just go back to the 90 days, and I'll also show you the effect of volatility. Now, let's just say the particular stock is quite volatile, moves around a lot. Now, we'll leave the volatility figure there at 19%, and what I'll do is I'll change the selling volatility, and we'll just see the two different figures here. So I'll just go back over here, and let's say the volatility is not 19, but it's actually around about 29%. If we go over here and look at our options, look at the big difference we get in the price. 45 cents when the volatility is 19%. When it's 29%, the option value is worth 64 cents. And that's because the model, and this is how it actually works in reality, if there's greater volatility, you can expect people who are wanting to sell options will want a much higher price for it. And that has a very, very big effect on the value of an option. Plus, obviously, the time factors as well. And again, we'll just go back and I'll change this one up to 29%. And you can see there it's worth 64. Just one change there. Massive change into the volatility. We'll go back to 19 and 20%. And I'll just quickly show you also the effect a dividend has. Let's say that our stock ABC is about to pay, say, a 30-cent dividend. And the particular option series that we own expires after the dividend. So therefore the options are tainted by the dividend. So if we put 30 cents in here, watch what happens to the value of the calls and the puts. Notice the calls dropped in value and the puts went up in value. And that makes sense because we know when a stock goes ex-dividend, it will drop by that dividend amount. So the options market will, through the formulas, can have a means to work that out, and that is reflected in the options price. Whether or not the options will stay like that is all dependent how the stock reacts after it goes ex-dividend, but you can see there how a 30-cent dividend in the case of ABC affected the options price. If we go back again, no dividend, you can see the options are 45.31 respectively for calls and puts. With a 30-cent dividend, we can see the calls are only worth now 29 cents and the puts are worth 45. And the last one I'll just show you is that theta value. Over here we've got a value of 0.003. Now what does that really mean? Well, it'll mean that our particular option would lose about 3 cents if 10 days pass. So if we go from 90 days to 80 days, what's the value of our 45-cent call option and put option? There's your 3 cents. It was 45, it's now 42. If we now go down, you'll notice that the theta is still staying at that level there. That's because we still have a lot of time. But if we actually had, say, 20 days remaining, you'll see there that the theta value is now at 0.005. In other words, it's going to lose half a cent a day. So if we go back to our model and we have, say, 2 days expire, we go from 20 to 18 days, you'll see that the value of the call and the put should decrease by at least 1 cent, and they did. So there's just a very quick run through on some of the fundamentals of options in terms of how they can affect the prices. Your Ord Minute advisor can give you more details in that regard.